about halfway through these Fed rate cutting cycles, silver tends to bottom. So what's impressive is if you look at the average of the last 3 rate cutting cycles, silver gained 332%. If you assume, now the timing's a little bit off this time, I'll be honest and admit that in terms of where silver bottomed, because silver, for me at least, in this cycle bottomed around the end of February last year, around $22. I believe that's where it was. We're now, I believe, at the midpoint of the Fed rate cutting cycle because they paused and now they've resumed. In any case, if you use the bottom from last February and you project upwards, that would take us to $95 silver.
Peter Krauth, editor of Silver Stock Investor and author of The Great Silver Bull, says silver's latest rally marks a major break from the past. In both of the previous bull runs, 1980 and 2011, silver prices surged almost vertically, spiking near $50 before collapsing. This time, the rise has been more deliberate. The metal climbed steadily to $50, then pushed as high as $54 before easing back, and it's still holding close to that level. That steadier pattern suggests a healthier, more sustainable move rather than a speculative blow-off. Now that silver has finally broken above its 1980 peak, Krauth believes $50 could become the new long-term floor as the market prepares for its next advance. He points out that the macro backdrop strongly favors precious metals. Before the pandemic, inflation hovered around 2%, and central banks were frustrated trying to push it higher. Today, inflation averages closer to 3%, still above the Federal Reserve's target, but policymakers have already started cutting rates. That shift tells you everything. The Fed has chosen to prioritize growth and employment over strict inflation control, effectively accepting a weaker dollar as the cost. For gold and silver, Krauth says, that's a perfect setup. As for the current dip, he doesn't see it as a warning sign. Silver's pullback from $54 to the $46.48 range is a natural breather after a strong rally. In fact, he sees it as a positive, cooling off speculative excess and setting the stage for renewed buying. The fundamentals remain solid, global demand for physical silver continues to climb, and the long-term technical picture still points decisively higher. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
You know, if you look at the last 2 times that it reached 50 or close to 50, 1980, 2011, both of those times we had parabolic rises. This time we had it might feel parabolic to some over this, especially the last, say, 6 months or so. It has been a very, very sort of steady rise and you had some days full dollar gains, but this is a lot more steady in terms of approach to $50. It's a lot more sustainable. We had it meaningfully past $50, up to $54, as you said, and now still hovering near that level, even though it has pulled back. So very, very different kind of approach to the $50 level. And, I've said that that was going to be a milestone, a huge milestone for silver. It had been until recently, till it took out $50. It had been the only metal that had not meaningfully surpassed its 1980 high. That's now the case, although, again, it has pulled back. But I do believe that it's going to regain 50. 50 will become a new floor, and for various reasons we can talk about, move considerably higher from there. It's interesting to note, if you look sort of on a larger time scale, pre-COVID, inflation hovered around 2%, averaged, let's say, around 2%. And I remember distinctly the Fed and other central banks were almost desperate to get inflation to pick up. We had rates at 0 for some time. We had negative real rates. And now, since post-COVID, we're averaging closer to 3%, which is 50% above their target. Their target is still 2%, I think, unrealistic. But so we're hovering at 3%. And yet, as you said, they're cutting rates. So I felt over the past year, at least, that the moment, and I figured it would come around this time, late this year, likely to see them start cutting rates again. And we have that now. And yet, as you said, we have them cutting rates in the face of either high or high and rising inflation. So I had been saying that was a bit of a situation where you investors would say they've essentially given in, right? They have to choose between employment and inflation, and so they've chosen to support employment and sacrifice inflation, sacrifice the dollar. And so since they're cutting, supporting employment, and again, as I say, in the face of high and or rising inflation, that's just a nirvana for precious metals, and that's why you've seen them. I think that's what gold and silver were sniffing out for the past, say, 4 to 6 months. We've seen it come to fruition. It's a bit of buy the rumor, sell the news. The news has happened. And so we've seen this pullback. It had gotten, in my opinion, I told my subscribers, I feel this is getting overheated. It went farther than I had expected, but we do see it pull back now. I'm happy, frankly, to see that. I think it's healthy. It's a good, healthy correction to see both metals come back. And I think it's a time, short, sort of near-term period where we're going to see these gains being digested, and then we're going to start to eventually move higher. So it has actually eased in the last sort of week or two, which is, I think, one of the reasons we've seen silver back off from, say, 54 to 46, 48. There was a lot of, so London is sort of the center for ETF silver storage, and that aside, because of arbitrage, because of concerns in the US that there would be tariffs on silver, a lot of silver had flowed out of London into New York. In fact, normally, because silver is bulky, usually you ship it. If you're not in a rush, you ship it. But because of the arbitrage opportunity and because of the pressures, a lot of it was flown. So, some of the dealers wanted it there very quickly. So a lot of this silver moved to New York. There was still demand for silver out of London, and that caused a squeeze. And we saw the silver price move up. We saw supply dry up dramatically. We saw things like in the futures markets, we saw what we call backwardation. In other words, the near-term price or physical silver was more expensive than longer-term silver contracts, which is not the normal contango state of things. So not typical. We saw lease rates go up to 39%. The day silver peaked at $54. All of these are big indicators of dislocations in the market. So there's no doubt that the physical market was very tight, and we're starting to see, and I think we're going to see this a lot more, and ultimately it's going to be the new way, but that it's the physical market that is now going to start determining the price as opposed to the futures market, the paper market determining the silver price.
Peter Krauth says most forecasting agencies tend to err on the side of caution. They don't want to lose credibility by predicting big growth that doesn't happen, so they keep their estimates conservative. That's exactly what happened with solar energy in the 2010s. The International Energy Agency, IEA, for example, repeatedly underestimated how fast solar would expand. Every year, they'd project installation numbers 5 years out, and each time the actual results ended up being roughly 3 times higher than expected. The reality was that innovation, falling costs, and policy support were driving adoption much faster than the models allowed for. Krauth says another key factor now accelerating solar growth is corporate demand. Major tech companies are leading the charge toward cleaner energy, and many want to secure their own power sources rather than depend on the grid. Some have explored nuclear energy, but that's viable only for a handful of massive corporations with deep pockets. Nuclear projects take over a decade to complete, while a large-scale solar farm can be built and generating power in just 18 months. That speed, scalability, and independence make solar the clear favorite. In fact, U.S. tech firms have been adopting solar at roughly 5 times the rate of nuclear in the past year. Let's get back to the interview.
I believe that these forecasting groups they purposely try to remain conservative. They want to maintain credibility and not sort of over promise, so to speak. Uh, and so you're right. Yes, through the 2010s, we've seen that the IEA was kept projecting 5 years out. Each year that they would project for the next 5 years, if you look back with the benefit of hindsight, they were off by 2/3. So installations were 3 times what they had been predicting, and this was year in, year out. So it is possible that installations, solar installations in China could be slowing. I'm not sure about plateauing. Maybe at least the rate of growth is slowing, but there are some things to consider. First of all, you've got this, we've talked about this before, but you've got this new technology that's kind of taking over. These are acronyms, but the established one is was PERC. Now the new one is TOPCon. Already last year, I believe, 63% of new solar panels were being produced with this new technology. That requires 40 to 50% more silver per panel. The reason you would do that is because they're more efficient. It justifies the higher cost per panel. You're getting more energy output from that panel. So although the producers, the manufacturers of the panels, have been for decades thrifting and trying to reduce the amount of silver that goes into each panel, I believe that we're going to start to see that trend up. In other words, they will probably start consuming more silver per panel. It'll take some time for this to show up in the statistics, but I think that's what we're going to see. So that's an additional source of demand for silver from even if demand stayed flat in solar panel production. Now you have this whole added layer of batteries. The cost of batteries and to store the power in batteries is falling and expected to fall by half over the next 10 years. We already expect for 2025 that we're going to see battery installations at 60% of 2023 solar panel installations. So that is really catching up very quickly. And I think the takeaway from battery and solar is that battery helps to make solar what I view as baseload power. Obviously, solar is there when you've got sun, and then the problem is nighttime. But if you can store the if you can store the power that you've produced from solar during the day and then draw on that at night, then you can have this constant baseload power, which you get from things like nuclear, for example, or natural gas, whatever it might be that utilities use, coal, whatever else. And so that just makes solar that much more attractive. Then you've got a few other layers to add to this. You've got the fact that technology companies, most companies are looking to be greener. They're looking for sources of power that are considered carbon neutral, carbon free. Solar is considered one of those. And what we've seen is that you've got the large tech companies. Many of them quickly went to nuclear, but they were able to tap into underutilized nuclear capacity. And they have the billions or tens of billions it takes to, lock that up very quickly. And because it was untapped or dormant, you can kind of bring it back online more quickly. But if you're looking at new nuclear, you're looking at 15 years. Compare that to solar, you're looking at a year and a half to get a solar farm up and running. So it's 1/10 the time that it takes. And we've seen uptake from tech companies in the US adopting different kinds of power. They're adopting they're adopting solar to the tune of 5 times faster right now over the past year or so. So you see that solar is certainly attractive to them. And you're not depending on a utility that's producing the power and to be connected to that utility. Many times you can actually have, if you've got the land to build out the solar farm, you can be completely off grid, so to speak. So you've got your farm, you're drawing the power from your solar farm, and you're not depending on someone to provide this power to you. So that's very appealing.
Something about silver feels different this time. It's not the wild, euphoric surge that burns out in a few weeks. It's a slow, deliberate climb that seems anchored in reality rather than hype. The forces behind it go beyond traders and headlines. There's structural demand being built into the system, especially as clean energy transitions from promise to policy. Every new solar panel, battery plant, and data center quietly adds to silver's long-term story. Unlike previous cycles, this one isn't chasing a quick peak. It's laying the groundwork for a new equilibrium where silver plays a vital role in both finance and industry. Monetary policy is shifting too. The age of cheap money is morphing into one of strategic spending and controlled inflation. That backdrop gives real assets a lasting advantage. Silver, once treated as gold's volatile cousin, is beginning to carve out its own identity, part industrial engine, part monetary anchor. The price action reflects that maturity, resilient, grounded, and increasingly central to how the next decade of energy and economics will unfold. If silver keeps proving itself as both a critical resource and a financial refuge, could it finally break free from gold's shadow and define its own era of value? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.